Namaskar. This is Akhilesh Bhargav. Welcome to Tit-Bits on Business and Finance with me. To the veterans in the investment, financial and capital markets, it is a phenomena that takes place almost every decade with predictable regularity. It begins with a particular sector catching the fancy of the investment and merchant bankers, catching the fancy of the P and the VC funds, and also of the stock market brokers. These are a band of ever vigilant entities eager to make big bucks. Soon, tons of investment starts flowing in companies in that sunrise sector, which is in the spotlight of these PE funds, etc., unmindful whether the investee company is viable or not, whether it is sustainable or not, whether it is making profits or not, or whether it can even ever make profits. In that mad rush, the most unviable entities, but which bear the tag of that fancied sector, are given the most absurd valuations, to which the most seasoned P and VC funds also succumb to, and they pour copious money into the company, confident that they are the only smart ones around and that they will somehow manage to get a profitable exit from that investment. These funds thus keep funding the losses, popularly called the cash burnout of these bleeding, loss-making entities, shockingly, at a bigger valuation in each funding round, even though the company has made no profits and all the past funding by these funds has been lost by it. They yet give it a higher valuation in every subsequent round of funding. Interestingly, while the party lasts, most of these funded entities incur uncontrolled expenses and their promoters live a lavish lifestyle at the cost of investor money. Then, why are such investments made? The fact that some investors manage to make a killing by exiting during the frenzy of investment only emboldens the others to join the mad rush into the sector. They risk their funds very well aware that the profitability or chances of making profits on these investments are very slim. It is the investment bankers and fund managers who earn enormous fees and fat bonuses on these investments, and it is they who love to see such kind of a boom taking place. They therefore hype up the prospects of this sunrise sector and its companies even more than what it maybe was justified, thus sucking more and more funds into these unviable entities. It is apparent that the king is naked here, but no one is willing to say so because all the intermediaries in the game, whether it be the investment bankers, the fund managers, the consultants, the valuers, the stockbrokers, etc., they are all reaping huge profits, huge fees, huge bonuses out of these mindless investments which are taking place. That's how the frenzy starts and it builds up. But then, how does this frenzy end? Because that's what happens every decade. Till the time money keeps flowing into the sector so as to keep the loss-making entities afloat, the entity valuation keeps rising and so does the hype and the clamor to invest in them. But as soon as the availability of funds depletes, the absurdity of valuations built on funding of losses becomes apparent, and soon the sector falls from the grace. The tide of funds recedes rapidly and most investors and companies are left stranded. Without the availability of new funds to replenish the losses, the non-viability of the entities and the losses that they bleed becomes apparent, and that's the end of the false boom. The bogus valuations and the investment frenzy also starts petering out. The era of unviable companies and unprofitable ventures, of at times even incompetent promoters who experimented in business at the cost of VC and PE funds during this hype, comes to an inglorious end with this. It may be an unprofitable end for the PE and VC investors who will get stuck with their investments, but it is certainly not so for the investment bankers, for the consultants and brokers, etc., who brokered these deals of the investments into the fancied sector for fanciful gains, for fanciful profits, huge fees that they make in the process. We saw this happen in 2001 when the mad rush to invest in dot-com companies collapsed, leading to huge investor losses then. We then saw it in 2008 when many a fancy tech and finance company went bust, and that is what is happening now in the case of startups. This frenzy to invest in startups could have continued for a few more months, but for the Ukraine war, but for the geopolitical friction, the surging commodity prices, the supply disruption and record inflation, which has brought in monetary tightening and has drastically reduced the flow of funds into this sector and also in many others. But it has exposed the structural weaknesses of the startup entities and the unviability and unprofitability of these entities, which have at times attracted record valuations. With dollars rushing back to the USA, the prices of such companies have collapsed on the stock markets, led by a fall of about 25% on the Nasdaq this year, and many others, tier 2 companies, losing 50 to 60% of their market valuation. With investors facing rampant listing losses, the sector is now being reviewed and assessed with conventional metrics of profitability, operating cash flows, self-sustainable operations, and the fact that the cash burnout of companies does not sustain for very long. Investors are not going to keep funding it. Suddenly, traditional and prudent metrics come into sight. The march of investors out of the sector in India has begun, and new funds are being committed more and more on the basis of prudent traditional parameters of judging a company's prospects by metrics and parameters like operating cash flows, profitability, and self-sustainability of the company, and that long years of losses by a company will not work anymore. They are not going to be funded by the investors. Thus, in the year 2022 so far, about $6 billion were invested in Indian startups by these funds, showing a decline of 33% as compared to the same period last year. As compared to the preceding quarter of March 2022, the dip is even more. In March 22 quarter, the amount invested in startups was $15 billion, and in this quarter, it has been $6 billion, showing a decline of 60%. And there are signs of a continued deceleration in these investments. The number of new unicorns in India in this year has fallen sharply, and many unicorns of last year may see a huge dip in their valuations and may even lose their unicorn status. The Economic Times reports that it is end of easy money for startups, the end of free lunches for them, and the start of cost cutting by startups in India. The ET report says that with dollars rushing back to the US, there is a global funding crunch, and amidst this tight funding environment, the money splurge for startups that was taking place is not happening anymore. It then says that the high cash burnout by startups is being questioned by funds and is not being supported by investors anymore, resulting in large-scale layoffs, resulting in reduced travel spend, trimming of marketing budgets, moving out of large offices by them into smaller ones, scaling back on employee perquisites, no free food at work, pay cuts for the top management, etc. All startups, now seeing that funds are not coming through, are indulging in cost cutting to stay afloat. It further says that the pressure is now on those startups which started with large capital investments and have not yet turned cash flow positive. The investor focus is now on profitability and on cutting costs. The ET report then mentions that since payroll and salaries account for a big chunk of expenses for these startups, layoffs and retrenchment is where cost-cutting focus is for them. It mentions then that the Unacademy CEO recently thus urged his employees to embrace frugality as a core value and turn the edtech firm profitable as soon as possible. The top management of Unacademy is taking pay cuts. Many startup founders are following suit, and they have fired thousands of employees, including by the likes of Byju's, adding to India's rising joblessness because of the retrenchment that is taking place. The maximum layoffs have occurred in the fintech, edtech, and delivery startups so far, and they continue. The reality is that the P and VC funds have now become much more cautious about their startup investment strategies. Many have taken a beating on their listed stocks with the new age tech stocks trading much below their IPO prices on the bourses. The Business Standard thus says that the flood of capital may not have become a trickle as yet, but with stocks getting pummeled, the VCs and the PEs are being forced to review investments and their valuations. Moreover, since a majority of startups depend on VC funds, the international disruptions and vagaries have had a direct adverse impact on the startup ecosystem in the country. The larger picture that we see in this matter is certainly worth a discussion. The first point, investors no longer are willing to finance cash burnouts of startups forever, and startups now have no alternate but to pursue profitable growth, profitable operations. Profitability and cash flow matters the most for any entity, and startups cannot be an exception to that rule. If they want investments to come in, profitability has to be there. The second, only the fit ones will survive, and even for them, valuation models adopted by investors are bound to get much more realistic, much more stringent. The third, if startups do not turn profitable, they will not survive to be the engine of growth for the Indian economy as they were being projected to be. The next, startups need to build their reserves and be self-sustaining and not just depend on the VCs and the PEs. The focus has to be on profits, it has to be on healthy balance sheets. The investors will bet their bucks on startups with long-term prospects only, and thus the ease with which startups raise huge funds from the marquee investors is no longer there. The funding for startups will not stop, but it will get tougher. The pace of investments will, however, slow down considerably due to a more realistic valuation that they are bound to adopt, due to stricter due diligence taking place, and because of caution prevailing among the investors. As far as the regulator is concerned for capital markets, SEBI is expected to get stricter about the justification for value and premiums, about the issue terms, about disclosures in the prospectuses, about KPIs, ratios, etc. in permitting IPOs by the startups. To us, innovations and profitability will matter the most as the startup ecosystem returns to the old principle of profitable growth, which is actually the only sustainable mantra for a company to survive and for it to also attract investment from investors, whether they be P funds or whether they be individual investors. Business is all about profits. It is not about burning cash. And now with this reality, this wisdom dawning on the investors, I think it should be good for the sector. This is Akhilesh Bhargav signing off till we meet again. Namaskar.